for the defined contribution plan, after the employer and the employee have contributed, that amount is again invested. The amount is invested so that by the time an employee is exiting his or her place of work, then you will find that their investment would have accrued some profits, maybe we can call it profits, at a later date, so that the amount that they will get will now depend on how well or how badly the plan's investment performs. But you'll find that if the investment performs well, then the plan will be able to afford higher benefit to the employees. So they will be higher a scheme, and then the contribution invested to give maybe a possible positive returns. Then number two, we have defined benefit. So please don't confuse the two. The first one is defined contribution plan. The second one is defined benefit plan. Now, in defined benefit plan, the size of the benefit is predetermined. Predetermined means that now you calculate the benefit in advance, and then now you subdivide now what will be paid by the employer. So benefit is predetermined, and you'll find that the size of the investment in this case will be at an amount that is expected to earn enough returns to meet the obligation to pay the post-employment benefits, or what we call retirement benefits. Remember, I'm using the term post-employment because in certain cases, after an employee has worked for a number of years, then they can opt to retire in quotes or to take a before their retirement age. So make the members, what is the retirement age in Kenya? Retirement age in Kenya. Yes, members, you are soon going to work. What is the retirement age in Kenya? Yes. What is okay? Yes, Regina, our minimum retirement age is 60 for most of the employees, apart from now the judges and the lecturers. So if you want to work for more than 60 years before retiring, you either have to be a judge. Now that you are not taking law, so we cancel that. So maybe you can be a university lecturer. University lecturers, the retirement age is 70 years. And after 70, if you are still having some energy, you can be added now some other years now on contract basis. But for the permanent basis, the retirement age is 70 for lecturers and the judges. But for the other employees, the retirement age is 60 years. So that it used to be 55. So when President Kibaki took over and as so many people were due to retire and the government of the day had no money at that time, that is why the retirement age was pushed to 60 years. Now, there are certain items that are very important to make a clear distinction. Number one is funding. Now, funding is simply a defined benefit plan or maybe paying contribution into the plan. Then number two, the accounting for the cost of funding of a defined benefit plan. Now, for the accounting for the schemes that we have talked about, that is, we have talked about the defined benefit and then the defined contribution. We also have to mention a number of issues that will help us now to account for the two schemes. The first issue is a multi-employer plan. Multi-employer plan. Now, a multi-employer plan is simply a defined benefit plan. It is simply a defined benefit plan. And in a defined benefit plan, the entity should simply account for the proportionate share of the defined benefit obligation. So the proportionate share means that now what percentage of the basic salary, in most cases we don't use the gross salary, we use the basic salary. So what proportion of the basic salary will be contributed by the employer? What proportion of the basic salary will be contributed by the employee? In most companies, both private in Kenya, you find that the employee contributes 10% of their basic salary. So that is deducted from their basic salary and channeled into the defined benefit plan. And the employers, most of them usually contribute around 7 to 10%. So it will depend on the agreement between now the employer and the employees union. So that is the benefit or the defined benefit obligation. Then we also have the plan of assets, and we will look at it in a couple of minutes, and the cost that is associated with the plan, the cost that is associated with the plan. So I want us to move straight to now the defined contribution plans. We look at it in details. Now, in the accounting for payments into the defined contribution plan is straightforward. Number one, the obligation is determined amount that is into the plan in each period. So each depending on the amount of salaries or the wages that are paid to the employees. Then number two, we are not going to have assumptions to make, actuarial assumptions to make. So actuarial assumptions are now the methods or the percentages of calculating different items to be included in the defined contribution plans. And number three, if the obligation is settled in the current period or at least not later than 12 months after the end of the current period, no requirement for discounting. I hope when we are talking about discounting, we know what we mean by that term, the discounting. Remember, we have got the time value of money, and we are always told that a shilling today is worth more than a shilling tomorrow. So if maybe somebody is promising to pay you 1,000 at the end of December this year, you need to discount it to get its present value. So we have said that if the obligation is settled in the current period, which is not later than 12 months, then you will not be required to discount the amount. Number two, then we have the interest cost. Now, the interest cost in the income statement is the present value of the defined benefit obligation as at the start of the year multiplied by the discounting rate. So again, we are just mentioning those items so that when we move to the real calculation, we'll now apply what we have there. Then we have the balance sheet. Now in the balance sheet, the amount recognized as a defined benefit liability should be the total of the following. So we are just going to note them. One should be the present value of the defined obligation. Number two is any actuarial gains or actuarial losses. Number three is any past service cost, which is not recognized, and that we will subtract. Number four, the fair value of assets of the plan as at the balance sheet date. Then now if this total, the amount that we would have got there, is a negative amount, then there is a balance sheet in the balance sheet. So forget about the other terms. Then we move to the income statement. So we look at this when we are looking at the real problem. In the income statement, then for the income statement, we should consider the following. Number one is the current service cost. Number two is the interest. Number three is the expected return on any plan asset. Number four, the actuarial gains or losses. Number five, the past service cost. And number six, the effect of any curtailment or settlement. So in this topic, the last item that we'll be looking at is curtailment or settlement. So you don't need to be worried about that term. Now, the other item is the attribution of benefit to periods of service. Now, the period of service is now the number of years or the number of months that an employee works in a given enterprise. That is the period of service. Like for you guys, your period of service is 4 calendar years in Zetech University. So that is your period. So the same when you start working, the number of years or the number of months that you'd have taken in that organization, that is what we will refer to as the period of service. So the benefits must be attributed according to your period of service. So now if we consider a situation where a defined benefit plan provide for annual pension for former employees' retirement, then we assume that the size of the pension is 2.5% of the employee's salary in his or her final year for each full year of service. Then the pension is payable from the age of 65. So there we are assuming that now the retirement age is 65 years. Now for such a case, if for example an employee is expected to earn 10,000 shillings in his final year of employment, remember we are calculating the pension based on the final year salary of employment. That is why you find that nowadays in most of the universities in town, people who are close to their retirement age are going back to us. They are doing that to improve on their retirement benefit calculation, because the retirement benefit calculation will not be calculated based on your salary, but it will be based on salary. It will be based on the salary of your final year of the salary of your final year of service. So we are assuming that this employee is earning 10,000 and is expected to live for 15 years after retirement. So we are assuming that after retirement, the employee will live for 15 years. So the benefit that is payable for each year of employment would be calculated as the discounted value at retirement age of now 250 per annum. Remember now, we have got the 250 by multiplying 2.5%. 2.5, we have just multiplied 2.5. About my pen. So 2.5 divided by 100 times now the final year salary, which is 10,000. So if you multiply this, this is what will give us now the 250. This is just an illustration. So that would be 250 per annum, so per year, for 15 years. So these should then be converted to a present value to determine the current service cost for the year of that employee. So we will elaborate on that when we look at an example. Then now we should also look at now the probabilities which we should take into consideration in the calculation. So again, suppose that a benefit of 1,000 for every year of service is payable to employees when they retire at the age of 60. Now, provided that they remain with the employer until they retire, then suppose also that an employee joins the company at the age of 40 with 20 years to work to retirement. Now, the benefit that is attributable to each year of service is 1,000 multiplied by the probability that the employee will remain with the employer until he or she is 60. Now, since the benefit is payable at the retirement as a lump sum, it should be discounted to a present value as at the balance sheet date to determine the current service cost for a given year. Now, the obligation should be calculated as the present value of now. If the employee is to work for maybe 40 years, for example, then now we take 1,000 and multiply it by the 40 years. So the lump sum that will be paid now for that particular employee will be 40,000. Sorry. So we multiply that by 40 years. So the total amount will be 40,000. So those are just some hypothetical explanations on how we'll deal with the retirement benefits. Now, in accounting for this lump sum benefit on retirement, the benefit should be attributed to each of the first 10 years of the employee's service. and the current service cost in each of the 10 years should be the present value of now the amount is paid for the 10 years and so on. So maybe to illustrate this better, I want us to look at the question. If you've downloaded the notes, there is the question on the service periods. The question on the service periods. So I hope you can see it. Now under Huduma company, so maybe I can post it on our, for those who have not downloaded the note, let me post it on the public chat. Okay. Now under Huduma company plan, all employees are paid a lump sum retirement benefit of 100,000. They are paid a lump sum retirement benefit of 100,000. They must still be employed. They must be still employed aged 55 after 20 years service, or still employed at the age of 65, no matter what their length of service. So required, state how this benefit should be attributed to service cost. So we are told that if an employee has just worked for 20 years, if they have worked for 20 years with the same company, Huduma company, then even after attaining the age of 55 years, they will still be employed. In the second case is that once an employee has reached the age of 65, irrespective of their length of service, the company will still retain them. So we have two scenarios. The first case is that once an employee surpasses the age of 55, then if they have provided the service to the company for 20 years or more, then they will still be retained in the company. That is the first case. The second case is that if they have attained, any employee who has attained the age of 65 years will be retained in the company irrespective of the length of service. Even when they have worked for just 1 year, then they will still be retained. So we have those two cases. So we are told to state how this benefit should be attributed to service periods. How this benefit should be attributed. Now we are going to answer this in 3 parts, and we have to be attentive, please. Now, in the first part, we are considering employees joining before the age of 35. So maybe I can divide this in my board. So the first case, we are considering employees joining the company before the age of 35 years. So before means that less, those who are joining in less than 35 years. So for those joining before the age of 35 years, then the service first leads to benefits under this plan at the age of 35. This is because an employee could leave the company at the age of 30, And please listen keenly, an employee could leave at the age of 30 and return at the age of 33 with no effect on the amount or timing of the benefits. So that is why we are considering 35 years. Now, for that case, in addition to the service beyond age 55, remember the reason why we are considering this is that the first case is when an employee has worked for 20 years and is at age 55. That is where the 35 is coming from. If you deduct 20 years of service from 55, then you come with the 35. So that's why we are settling on that. So we are saying that in addition, the service beyond the age of 55 will lead to no further benefits. So therefore, for these employee company, what should be allocated for such a case now, because they are going to work for 2055, now we benefit some, which is 100,000. We take the 100,000, divide by now the years of service, and the years of service in this case is 20. So what will that give us? What will that give us? If you divide 100,000 by 20, okay, thank you. Mwasi 5,000 shillings. Albert Waweru 5,000. So please don't just join the class, don't just log in and then you disappear. I will now start calling randomly so that we all participate. Anyango Oluoch, Joram Jenga, Kelvin Masharia, Belinda, Celia, 5,000, that is right. So now for this, the 5,000 shillings that we have calculated here will be attributed to each year between the ages 35 years. They will be attributed between the ages 35 years to 55 years. That will be attributed between the ages 35 years to 55 years. So that is the first case. Now, in the second case, I want us to look at employees who are joining between the age 35 and 45 years. Remember that service beyond 20 years will lead to no further benefits. So those who are joining between 35 and 45, so those who are joining between 35 and 45, again, the company should allocate the same amount because still they will work between 55 and 65 years if you add the 20 years of service. So again, we will still divide 100,000 by 20 years of service, and again, them also, what will be allocated will be 5,000 shillings to each of the first 20 years. To each of the first 20 years. So again, 5,000 shillings. Now, the last case is for the employees who are joining at 55 years exactly, for exactly 55 years. So those joining at 55, the third case. So if you join at 55, remember you can still work up to the age of 65. So you would have given a service for 10 years. You would have given the company a service for 10 years, and therefore Huduma company should now allocate now 100,000. We divide by the years of service there. So 100,000 divided by the years of service, which it will now be 10. So what will that give us? That will be 10,000. Yes, Mwasi. Rebecca, Kimani, Kelvin, Masharia, Joram Jenga, Regina, Nyango, Oluoj, Cecilia. So that is 10,000. So that is what will be attributed to the years of service. So that is what will be attributed to the years of service. Now, next I want us to look at actuarial assumptions. Actuarial assumptions. Now, the actuarial assumptions are needed to estimate the size of the future benefits that will be payable under a defined benefit scheme. And there are various categories of the assumptions, various categories of the assumption. The first one is the demographic assumptions. Demographic assumptions, which are simply based on the mortality rates before and after retirement. They are based on the mortality rates before and after retirement. So mortality rate is now how long are people living in that particular country, maybe post-employment or after retirement. The demographic assumption will also be based on the rate of employee turnover. They are also based on the early retirement cases that have been taken by employees in that particular company or government. Then number two, we have the financial assumptions. Now the financial assumptions are the discount rate to apply, the expected return on the plan assets, and also the future salary levels. The future salary level. So what is the rate of increase of maybe the salaries in that particular company or in the government? Now, the discount rate that is adopted should be determined by reference to the market yields. They should be adopted by reference to the market yield. But in our case, we'll not look at the market yield. We'll always be given the discount rate. But maybe if some of you would have be lucky after school to work in the pension maybe department or the pension schemes, you'll have to look at the market yield to calculate the discount rates. Then we have the actuarial gains or losses. Now the actuarial gains or losses arises because of a number of reasons. The first cause may be the actual events, for example, the employee turnover or the salary increase. So sometimes employees they may demand for a salary increase. You've seen in many counties in Kenya was going on strike, and before they resume, maybe they have to agree with the governor and the CECs in charge of maybe the finance to increase their pay. So that can be an actual event that is causing actuarial gain or an actuarial losses. So we have said that the actuarial gains or losses may arise because of one, the actual events, which we've about being different from the actuarial assumptions that were made to estimate the defined benefit obligations. Number two, the second cause is that the actuarial assumptions may also be revised. The actuarial assumptions may also be revised depending on maybe the salary increases, depending on the mortality rates. It may also depend on the different discount rate that is used. And then the last cause of the actuarial gains or losses may be because of the actual returns on the plan assets being different from the expected returns. So remember that in most cases, the actual return is not always the same as the expected return. So in such a case, you find that there may be an actuarial gain or an actuarial loss for such a case. So any question up to that point? Any question? Any clarification that you need? Now, since the actuarial assumptions are rarely going to be exact, some actuarial gains or the losses will be inevitable. And the proposed standard suggests that given the inability of the actuarial gains or losses, they should not be recognized unless they appear significant. Unless they appear significant. Now remember that when you are looking at the accounting concepts, there is the materiality concept, which I still think you remember. Cecilia, do you remember materiality concept in your financial accounting one? Cecilia? Yes, Cecilia? Okay. Joram Jenga, do you remember? Oh, Cecilia is typing. You can write, Cecilia, you can write on our board. I've enabled the you to write on the board. Just write on the board there. Joram, you can also write on the board, not on the public chat. I've enabled the multi-user. Yes, just write. Joram, do you remember the materiality concept? Okay, now what does it mean? Yes. Yes. Any information? Any information? Material. Okay. If you are finding it difficult, just type. Okay. Kelvin Masharia, the materiality principle states that an accounting standard can be ignored if the net impact of doing so has a small impact on the financial statements, that a user of the state would not be misled. Yes, that is correct. That is correct. Kelvin Masharia. So, for example, if you are maybe calculating 20 times maybe 0. Let me see, 0.11. Yeah. If you are calculating 20 times 0.11, this should be Jenga is saying any information, whether small or large, is relevant to accounting information. Yes, I agree. I agree, yes. But in materiality concept, we can ignore any information that has no effect on the user of such an information. And I was trying to give you an example of if we are multiplying 20 by 0.11, for example. I just want us to show something. If we are multiplying 20 by 0.11, this is 2.2, isn't it? That is 2.2, sorry. It should be 2.2. My body is misbehaving. It should be 2.2. So now for this, if I record this transaction as the 2.2, I can round off this to 2. And since the 0.2 there is negligible, even if I record this as 2, this is allowed under the materiality concept. But if I was talking about 20 billion Kenya shillings, for example, multiplied by 0.11, then that should be 2.2 billion. So in that case, the amount will have a bigger effect on the transaction. So I cannot assume the 0.2. I cannot round off this to 2 billion, because now by doing so, I would have misled the user, because what is a 0.2 of a billion? A 0.2 of a billion is 200 million Kenya shillings. That is not a negligible amount. So that is what I'm talking about. Even now in the actuarial gains or losses, we are saying that we should not recognize them unless they appear as significant. And I've shown you the two cases. Remember, if we are just multiplying getting the sum of maybe multiplying 20 by 0.11, the product there will be 2.2. So if you record this as 2, then that is just okay. But if we are talking about 20 billion and we are multiplying it by 0.11, the product there will be 2.2 billion. So 2.2 billion, we cannot assume the 0.2 over, because it is quite a significant amount of money. Now, the standard requires the following. Now, for the actuarial gains and losses, number one is that an entity should, as a general rule, recognize actuarial gains and losses as an item of income or expense. Now, that is in the income statement. We recognize actuarial gains and losses as an item of income or expense. So when should it be an income and when should it be an expense? It will be an income if it is an actuarial gain, but it would be an expense if it is an actuarial loss. Number two, we are told that only a portion of the actuarial gains or losses should be recognized if the net cumulative actuarial gains or losses exceed the great amount of 10% of the present value of the defined benefit obligation or 10% of the fair value of plan assets. So you have to first of all get now the present value of the defined obligation. If now the actuarial gain or loss is greater than 10% of the present value of the defined benefit obligation, then we should consider the actuarial gains or losses. Or if the actuarial gains or losses is greater than the 10% of the fair value of the plan assets, so don't worry about the plan assets, we'll look at it as part of our unit. So if it is greater than the 10% of value of the plan assets, then now we should consider the actuarial gains or the actuarial losses. Now, a separate calculation should also be made for each defined benefit plan. Two or more plans should not be aggregated. So what we mean is that you should not have a calculation for two or more plans. We should have a calculation for each and every plan. Now we can move to the past service cost. So still we'll use the concept of the actuarial gains and the actuarial losses. Here we are just mentioning them, but now when we look at the actual calculation, now we'll have to understand better. Now, a past service cost arises when an entity either introduces a defined benefits plan. So we are talking of past service cost. Past service cost. So a past service cost arises when an entity either introduces a defined benefit plan or improves the benefits that are payable under an existing plan. For example, an employer may decide to introduce medical benefit scheme for former employees. Now, this will create a new defined obligation that has not been provided for. Now, to look at how this should be accounted for, I want us to look at the, yes, on cover, I'm waiting. I'm seeing on cover, a past service cost will arise when an organization either introduces a defined benefit plan or improves the benefits that is payable under an existing plan. Now, those are the two cases where now a past service cost can arise. An employer may introduce a defined benefit plan, or they may also decide to improve on the benefits that is payable under an existing plan. And we have given an example of maybe an employer introducing a medical benefit scheme for former employees. So if that is done, then you will find that introduction of the new medical benefit scheme will create a new defined benefit obligation which was never provided for. So we can look that into details by looking at the question that we have there. The question for the past service cost, where we are told Wakili company operates a pension plan that provides a pension of 2% of final salary for every year of service, and the benefits become vested after 5 years of service. Now, on January 2016, Wakili company improved the pension to 2.5% of the final salary for every year of service starting from 1st January 2012. I think you have that, or I can post it there on our public chat. Do you have the question that I'm reading? And then we are told, okay, let me post it, Njenga. Okay. Now, Wakili company operates a pension plan that provides a pension of 2% of final salary for every year of service, and the benefits become vested after 5 years service. Now, on 1st January 2016, Wakili company improved the pension to 2.5% of final salary for every year of service starting from 1st January. So it was to be backdated to 1st January 2012. Now, at the date of improvement, the present value, the additional benefits for service from 1st January 2012 to 1st January 2016 is as follows. The amounts are in million. Employees with more than 5 years service are to be, they were allocated 300 million. So maybe I can write that because it is not clear in our public chat. So those with more than 5 years, so we can say those with greater than 5 years, the amount that is allocated is 300 million. Now, employees with less than 4 years, sorry, less than 5 years. So those with less than 5 years of service, them they were allocated 240 million. So now the total amount allocated is 540. Okay, 540. So you find that this scheme was not there. The scheme was there, yes, but now this additional arrangement has been introduced just in January 2016. They have been introduced just in January 2016. So therefore, now the past service cost will now arise. So we are required to state the correct accounting treatment for past service cost. So again, this one is it is not complicated because it is direct. So what Wakili company should do is to recognize the 300 million shillings immediately. The 300 million should be recognized immediately. So the 300 million, this 300 million, remember these employees have worked for more than 5 years. They have worked for more than 5 years in the company, and the additional amount is given in January 2016 and backdated to January 2012. So if you get the number of years there, if you get the number of years between 2012 and 2016, that should give you in 2012, that is 1 year, 2012, 2013, 2 years, 2014, 3 years, 2015, 4 years, and then 2016, that will be 5 years. So what Wakili should do is that they should recognize 300 million immediately. So that is our recommendation is that one, they should recognize the 300 million shillings immediately, because they should recognize the 300 million shillings immediately because these benefits are already vested. The benefits are already vested. So that is the recommendation for those who have worked for more than 5 years. Then for those who have worked for less than 5 years, for those who have worked for less than 5 years, then the 240 million, shillings, 240 million shillings should be recognized on straight line basis. It should be recognized on straight line basis. I hope we remember the straight line method. So it should be recognized on the straight line basis over the number of years from January 2016. From January 2016. So that is what Wakili Kani should do. That for the 300 million, because these guys have already worked for more than 5 years in the company, they have worked for more than 5 years. So already this 300 million is supposed to have been paid. Remember, if you look at our question, we are told that the company operates a pension plan that provides a pension of 2% of final salary for every 5 years of service. So the pension is paid after every 5 years. After every 5 years, you are given the amount. So for those who have worked for more than 5 years, already that money would have been paid. So they are supposed to be given that additional service cost of 300 million immediately. But now for these other guys who have worked for less than 5 years, their amount should now be vested, or they should be recognized on the straight line basis, but now starting from January 2016. On the straight line basis, this means that now what will be considered is now the period of service. And again, depending on the total number of employees with their period of service. So the straight line means that now for every year, because the pension is paid after 5 years, we'll now divide 240 million by 5 to get now the pension that is supposed to be paid for a given year. So if you divide 240 by 5, I think that will give us 48 million per year. So every year, this is what should be paid every year, depending on the number of employees and their basic salary. So this will be paid at a rate of 2.5 of the basic salary. 2.5 of the basic salary. And what they are dividing is 48 million for every year. Any question up to that point? So if there is no question, I don't want to bombard you with so many elements today. We can stop there for our live session, and then